Welcome to this course on behavioral finance. Behavioral finance has become widely accepted as a way to improve the financial health of individuals and companies. Simply put, behavioral finance teaches us how to make better financial decisions. It was added to the CFP exam for certified financial planners. More and more planners are integrating behavioral finance to better serve their clients. Market analysts study behavioral finance to better understand market dynamics, trends, and opportunities. However, the concepts and implications of behavioral finance go far beyond personal financial planning. This course will show you the many ways behavioral finance can be used for better company management. This course begins with the emergence of behavioral finance, which introduces an overview of traditional finance and how behavioral finance challenges and augments traditional financial concepts. Next is a short section that talks about the ways we think about finances and how we make financial decisions. We'll then explore common biases and heuristics. Biases are predispositions we have towards certain errors. A heuristic is a rule of thumb. These biases and heuristics cause people, companies, and markets to deviate from traditional finance. Finally, I'll apply these concepts to personal finance, business financial decisions, retirement planning, and pricing. I'm Rob Stevens, founder of CFO Perspective. CFO Perspective provides finance and strategy resources for small businesses. I'm a CPA and have been the CFO of multiple companies. Most of my career has been in banking. I also have a master's degree in personal financial planning and a graduate certificate in financial therapy. I've been the program manager for a group of investment advisors. At banks and credit unions, I saw people making poor financial choices. I believed financial education coupled with insights from behavioral finance was the best way to understand their needs and help them achieve their goals. I used behavioral finance to better manage the bank's investment portfolios. Finally, it helped us as a management group make better decisions. Today, behavioral finance is foundational to how I build resources for small businesses and their advisors. These are some of the books I used to build this course. I reference these at the bottom of the slides if you want to do more research. Behavioral finance is a relatively young field. The authors of these books are the founders and giants of it. I want to make special reference to the author of the first book. Daniel Kahneman and Amos Tversky are the godfathers of behavioral finance. Kahneman, who is a psychologist, received the Nobel Prize in economics for the work he did with Amos. Sadly, Amos had passed away before the prize and so was ineligible as a co-recipient. I first developed the content of this course for an MBA class I teach at a university. I've adapted it for business advisors like CPAs, coaches, consultants, and accountants. It's also useful for financial employees at businesses. Because this was built for college presentations, I use a voiceover slide method for this course, whereas I talk more on screen and use more images in my other courses. Finally, you can't have a financial presentation without a disclaimer, and here's mine. I mentioned some trading ideas in this course, but I can't make any promises about their effectiveness for future results. Also, burning banknotes like this sidebar image is illegal under 18 USC Section 333. You should not literally burn money. This course will help you avoid metaphorically burning money. Let's start with a brief overview of traditional finance and how behavioral finance emerged from it and improved it. Some basics on traditional economics. I'm going to start this course with some basics about traditional finance. Behavioral finance starts with many of the assumptions or the concepts from traditional finance and then builds from there. And there are areas where they disagree, and there's areas where behavioral finance builds upon traditional finance concepts. So let's start with 5 foundation blocks of standard finance. First, people are rational. Now, I'm not talking normal person rational. I'm talking completely rational, Mr. Spock rational. And so that assumes a couple of things. One is that people know all the choices. So people then are almost assumed to know all. Secondly, they're able to rationally process and pick the choice out of all possible options. Two, people construct portfolios where people's portfolio wants include only the highest expected return for a given amount of risk. Three, people save and spend as described by standard life cycle theory, where people find it easy to identify and implement the right way to save and spend. So, just a very short summary of standard life cycle theory is that we tend to even out our spending at an amount that's an average of our overall lifetime income. Expected returns of investments are accounted for by standard asset pricing theory, where differences in expected returns are determined only by risk. Markets are efficient in the sense that price equals value for all securities, and in the sense that markets are hard to consistently beat. So let's talk a little bit more about risk. Baker defines risk as the probability of an undesirable outcome, for example, a decline in the market value of the stock market, and the magnitude and consequence of that occurrence. So to summarize, it's the probability of an outcome occurring, the magnitude of that outcome, and the consequences of that. Risk can be measured completely objectively, for example, through standard deviation, through beta, through variances. Investors form the optimal portfolio that provides one, minimal risk, or two, a specified level of return. And one way that we can reduce risk is to diversify our holdings. Next, let's look at some of the assumptions of the efficient markets hypothesis. The price of an asset is the expected value of all future cash flows. There are models out there like CAPM and the Fama-French five-factor model, and before that, the three-factor model, that can be used to calculate fair value. Current price represents all current information. It's difficult to consistently beat the market. Smart traders will force incorrect prices to the correct levels. And finally, investors may have biases. And so in behavioral finance, biases are very, very important. We're going to spend a lot of this course talking about biases and heuristics. And don't worry, I'll explain what those words mean later. But behavioral finance talks about these biases. And some people think that traditional finance doesn't recognize that investors have biases. Traditional finance does recognize this. But in traditional finance, the biases are considered to be unsystematic, so they offset in total, which means they don't have to be factored in completely into these models. The emergence of behavioral finance. Now we'll talk about how behavioral economics emerged from traditional finance. Behavioral economists found three major flaws with traditional economics. The first was that people can't or don't optimize according to economic theory. The second was that the beliefs upon which people make their choices are not unbiased, and certainly the biases don't wash across a market and can be ignored. Third, people make their decisions on many factors not included in traditional economic optimization models. There are limits to human knowledge and human computational ability that prevent them from acting according to traditional economics. We just aren't completely rational, but there are limits or boundaries to our rationality. Some of these include an absence of complete and consistent utility function for all choices, the inability to generate more than a fraction of possible alternative choices, our inability to foresee the consequences of our choices, and our inability to assign consistent and reasonable probabilities to all the future events. Baker summarizes the relationship between behavioral finance and psychology this way. Behavioral studies typically only include a small element of psychology, integrated into the economic theory needed to understand the institution itself. In this way, behavioral finance adds only a slight wrinkle to traditional finance, which is to alter some or one of the facets of an assumption at the foundation of economic theory. How do individuals behave? So, this tiny little bit of psychology makes a huge difference to economic theory, but it's clear also that behavioral finance builds mainly off of traditional finance. Traditional corporate finance focuses more on what corporate managers should do rather than what they actually do. So, traditional finance is normative, while behavioral finance is descriptive. Thaler says the field of economics appears to be converging on what I call evidence based economics. Most traditional economic theory is not derived from empirical observation, it is deduced from axioms of rational choice, whether or not those axioms bear any relation to what we observe in our everyday lives. So, in a way, you could talk about behavioral finance as evidence based economics. So, another way to explain this is that traditional finance explains how to pilot a boat in a calm sea of rationality, while behavioral finance shows how to navigate in the tides, the currents, and the storms of human emotion and rationality. So, now let's take those five foundation blocks we looked at earlier in traditional finance and compare them to what the assumptions are in behavioral finance. We'll start with the first. People are rational. And remember, in traditional finance, this is uber rational. This is Vulcan, Mr. Spock rational. This is completely all knowing and impassionately being able to make decisions rational. Whereas behavioral finance says people are normal, which is the rationality we experience in our day to day lives, which, as Dan Ariely called it, is predictably irrational, but it's certainly not the complete rationality assumed in traditional finance. Second, people construct portfolios as described by mean variance portfolio theory, where people's portfolio wants include only high expected returns and low risk. This is the traditional. Now, in behavioral finance, behavioral economists would say that people construct portfolios as described by behavioral portfolio theory, where people's portfolio wants extend beyond high returns and low risk, such as wants for social responsibility and social status. Third, in traditional economics, it's assumed that people save and spend as described by standard life cycle theory. Now, in behavioral finance, people save and spend based on behavioral life cycle theory, where impediments such as weak self control make it difficult to save and spend in the right way.